3 weeks ago, I got a phone call I wasn't expecting. It wasn't from a reporter, it wasn't from someone in my current finance circle. It was from a former senior official I hadn't spoken to in more than 10 years, someone who spent years inside the core of the US financial system, the kind of person who understands how money really moves behind the scenes. When I picked up, he didn't say hello and he didn't ask how I'd been. The very first thing out of his mouth was a question. How much cash do you have outside the banking system right now? I told him the amount. Then the line went quiet, not the kind of pause you get when someone's searching for words, but the kind that feels heavy. After a few seconds, he spoke again, and what he said is the reason we're having this conversation today. He said, "You should probably double it before April." When someone with that level of experience says something like that, you don't shrug it off, you ask why. People who've spent decades inside the system don't issue warnings lightly. They know how markets behave, how banks really function, and how financial stress usually builds long before the public sees it. What made the moment stand out even more was his tone. Calm, steady, no drama, just quiet certainty. That's how the most serious financial cautions usually sound. Calm, direct, specific. Since that call, I've spent weeks digging into what he might be seeing, going through bank balance sheets, government debt numbers, credit markets, and commercial real estate data. And what I found is something retirees, in particular, need to understand right now. Because the risks in the financial system today don't necessarily look dramatic on the surface. Stock indices are near record highs. Headlines talk about growth, AI, and strong employment. Everything appears stable. But stress in finance rarely starts where everyone is looking. It begins in the plumbing of the system. And when those pressures build long enough, they can turn into visible problems very quickly. The question is not, will the banking system vanish tomorrow? That's not how stress typically plays out. The real question is whether individuals, especially retirees who depend on savings and fixed income, are positioned safely if markets become unstable again. That's what we're going to unpack today. Because there's a specific reason some professionals are quietly telling people to think carefully about how much they hold inside the banking system versus how much they keep easily accessible outside of it. Hi, I'm Olivia, and today on the USA Guide, we're going to talk about something that doesn't get nearly enough attention in retirement planning, the structure of the banking system itself, and how retirees can protect their savings if financial conditions shift. This isn't about panic. It's about understanding how the system works and making sure your finances are arranged to give you flexibility and security regardless of what happens in the broader economy. Over the next few minutes, I'll walk you through several key points. First, we'll revisit a banking event from 2023 that most people know from headlines, but few really understood. Then we'll look at some of the hidden pressures still sitting inside parts of the system today, tied to interest rates, commercial real estate, and government borrowing. After that, we'll talk about the early warning signals professionals watch when stress starts to build. And most importantly, we'll tackle a practical question many retirees are asking. How much money should you reasonably keep outside the banking system so you're prepared if markets turn volatile? Because there's a common belief that as long as your money is parked in a bank account, it's automatically safe no matter what. And while the banking system has strong protections, there are limits and mechanics every depositor should understand, especially if you've spent decades building retirement savings and want to safeguard that capital carefully. Before we talk about actions, we need to go back to March 2023, because what happened then exposed a weakness that many people are still overlooking. To understand why professionals are watching banks more closely again, we need to review what actually happened that month. Most people remember the headlines. A major bank failed almost overnight. Coverage described it as a sudden crisis. Regulators stepped in over a weekend, and within days the story faded. For many, the conclusion was one bank failed, the government stepped in, problem solved. But the deeper story was more important. That bank didn't collapse because of classic fraud or reckless subprime lending like 2008. The root issue was simpler and far more common: interest rates and bond values. During the years of near-zero rates, banks bought huge amounts of long-term government bonds and mortgage-backed securities. At the time, that looked conservative. Rates were low, the economy seemed stable, and government bonds are usually considered among the safest assets a bank can hold. Then the Federal Reserve raised interest rates at the fastest pace in over 40 years. When rates rise, the market value of existing bonds falls. A bond paying 2% isn't attractive when new bonds pay 5%, so the old one trades at a discount. That drop in market value left many banks with large unrealized losses in their bond portfolios. On paper, a lot of banks were suddenly sitting on significant mark-to-market losses. Normally, that isn't fatal because banks can hold bonds to maturity and get full principal back, as long as depositors leave funds in place. The trouble starts if depositors pull money quickly. Then a bank may have to sell those bonds at their lower market value to raise cash. That's what happened. In around 48 hours, depositors moved billions out via online transfers and apps. The speed of modern banking turned what once might have been a slow problem into a very fast one. Regulators stepped in, took over the bank, and guaranteed deposits to prevent wider panic. On the surface, the situation was contained. But analysts noticed something critical. The bond losses weren't unique. They were spread across many institutions. Official data showed that U.S. banks collectively held hundreds of billions of dollars in unrealized bond losses from the low-rate era. Again, these aren't immediate failures waiting to happen. They sit quietly unless forced into the open by liquidity stress. But they represent a vulnerability, a pressure point that can be exposed under the wrong conditions. And bonds are not the only area of concern. Another sector, far less visible in everyday news, is commercial real estate. Work patterns have shifted dramatically. Remote and hybrid setups have reduced demand for traditional office space. In cities like San Francisco, Chicago, and New York, office vacancy rates have climbed to levels that would have seemed extreme a decade ago. Empty floors, in some areas nearly a quarter of space unrented. Less occupancy means less rent. Less rent means lower building values. And many of those buildings were bought or refinanced when interest rates were very low. Owners took on large loans assuming stable rents and manageable borrowing costs. Today, refinancing is more expensive and demand for office space is lower. Over the next few years, a large wave of commercial real estate loans will hit maturity. Borrowers will either refinance or repay. If refinancing costs spike or property values have fallen too far, some loans may default. A key detail, a lot of these loans sit not on the books of the biggest global banks, but on those of regional and mid-sized banks, the same class of institutions dependent on deposits. This doesn't mean a guaranteed wave of failures. Regulators are watching, banks can raise capital, and situations vary. But it does mean that banks are juggling multiple pressures at once. Bond portfolios impacted by higher rates, and commercial real estate loans facing uncertain refinancing conditions. When you combine those with something even larger, the government's own financial position, you start to see why some professionals are becoming more cautious. The banking system sits inside a broader financial ecosystem shaped by U.S. government borrowing, interest rates, and global demand for treasuries. The national debt is measured in tens of trillions of dollars. That headline number is huge but abstract. What's more tangible is the annual interest bill on that debt. As rates have risen, yearly interest costs have climbed above $1 trillion, exceeding spending on many major federal programs. The government funds itself by issuing Treasury bonds. Those bonds must be bought by investors. Historically, foreign governments and institutions took a large share. Countries with trade surpluses recycled dollars into treasuries, helping keep rates contained. But global patterns are shifting. Some countries are slowing their accumulation of U.S. debt. Others are diversifying reserves. As foreign demand moderates, more of the government's borrowing has to be absorbed domestically by U.S. banks, pensions, insurers, and funds. In effect, more of the financial system's capital is being funneled into funding federal deficits. That can crowd out other uses for capital, like business lending or investment, and push borrowing costs higher. At the same time, the Federal Reserve is no longer adding liquidity like it did during the pandemic. It's in a phase of quantitative tightening, allowing bonds on its balance sheet to mature without replacement. That steadily drains liquidity from the system instead of injecting it. Think of a reservoir slowly being lowered. It may not be obvious day to day, but over time the level drops. Put together, higher rates, large government borrowing needs, reduced Fed liquidity, and sector-specific issues like commercial real estate, you have a financial environment that is tighter and more sensitive than just a few years ago. Tightening conditions don't automatically produce a crash. Markets can adapt. But historically, periods like this tend to reveal weak points in unexpected places. Stress often shows up first in places most people aren't watching: short-term funding markets, credit spreads, and the stock prices of vulnerable institutions. That's why experienced investors monitor specific indicators, not to predict exact dates, but to see when pressures are building. Common gauges include the yield on the 10-year U.S. Treasury, a benchmark that influences mortgages, corporate borrowing, and valuations, the performance of regional bank stocks, which can signal investor concerns about that sector, and corporate credit spreads, the extra yield investors demand to lend to riskier companies. When several of these move sharply in a stress direction at the same time, it suggests financial conditions are tightening faster than is comfortable. None of this guarantees a crisis, but it raises a practical question for individuals, especially retirees. If the environment becomes more unstable, how should you think about your savings? Should everything sit inside the banking system? Or should some portion be kept in forms that are more directly accessible? This is where the idea of financial resilience comes in. The aim is not to pull all money from banks or forecast disaster. It's to structure your finances so you're not forced into bad decisions if stress appears. One long-standing principle is maintaining a liquidity buffer, money that's easily accessible without depending entirely on the short-term stability of markets or specific institutions. For retirees, many planners suggest holding roughly 3 to 6 months of living expenses in highly accessible, low-risk forms outside long-term investments. This doesn't mean hiding large sums at home. It can mean a mix of small amounts of physical cash, short-term U.S. Treasury bills purchased directly, and other liquid holdings that aren't tied to any single bank's balance sheet. Combined with staying under FDIC insurance limits per depositor per bank, currently $250,000 in the U.S., and spreading larger deposits across institutions if needed, this kind of structure can significantly improve your ability to stay calm and avoid rushed decisions. The key idea is that having access to liquidity buys you time. Time to avoid selling investments at the worst moment. Time to wait through temporary disruptions. Time to think clearly. Historical market downturns from 2008 to the pandemic shock have shown that those with prepared liquidity and diversified portfolios were often able not only to endure volatility, but to take advantage of opportunities that followed, buying quality assets at discounted prices. Retirees understandably worry about market declines threatening their nest egg. But thoughtful planning can turn volatility from something purely scary into something manageable. Ensuring that several months of expenses are covered without touching long-term investments is one of the most effective ways to reduce pressure. None of this is about trying to time the market or banking system. It's about accepting that uncertainty is a permanent feature of finance and designing your personal structure accordingly. Financial security rarely comes from predicting the future perfectly. It comes from being positioned so that, whatever happens, you don't have to panic. That's why, instead of reacting to every new headline, it makes more sense to calmly review how your money is organized, confirm your deposits are within insurance limits, consider a reasonable liquidity buffer, diversify across asset types and institutions, and align your plan with your actual spending needs and risk tolerance. This video is for educational purposes only and is not financial advice. Everyone's situation is different, so always do your own research and consult a qualified financial professional before making decisions about your own money.